Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. I'm really pleased to welcome back to the microphone and screen Glenn Butcher from FundWA. Now, ladies and gentlemen, you might remember a little while back we had Glenn on for part one of this actual radio interview, but we had so much to talk about, and Glenn was kicking me virtually through the screen saying, "Shut up, Ray. I'm the one being interviewed because I couldn't shut up." I love this stuff, and I love talking about venture capital, and I love talking about VCs, and I love talking about startups because that's all the cool stuff that we're out there buying and looking at. And I just think it's absolutely wonderful. So, Glenn, thanks and welcome back.
Thanks for having me.
Wonderful. Now, look, last time we spoke fairly generically around the entire VC market and what's happening here in Australia. And I think it might surprise a lot of people. And you pointed it out, and we know, there's a lot of success stories here in Australia. And I still think we do actually punch well above our weight population wise. But let's talk a little bit now, if we sort of lift under the covers a little bit and start looking a little bit in the ecosystem. In other words, who are the players that are involved in the venture capital area? And I guess the first one, when we're talking about, are the actual entrepreneurs. Now, entrepreneur back in the 80s was a dirty word because that was sort of Alan Bond and, people were spectacular failures, but not quite so today. When you see an entrepreneurial founder, what do they look like? What's the typical entrepreneur look like these days, Glenn, that you hear pitches from on a daily basis?
People have an idea about what a typical entrepreneur looks like. I think driven by Facebook, Mark Zuckerberg, and so they think basically the typical entrepreneur is a 20-something white male who has got this single idea, possibly like launched their idea by quitting university to go and do their own idea instead, and that's kind of how the world works, and that's what an entrepreneur looks like. Entrepreneurs come in all walks of life, shapes, sizes, and ages, actually. So they can be 20s, but they can also be 60s. They can come from anywhere, and it's not about that. It's actually about them as a holistic person. In fact, the data shows that the most successful entrepreneurs are typically in their 40s or 50s. Um,
Wow.
yeah, because they've actually got some experience, some skills, and some networks they can call on, which allows them to be more successful. So I don't know. I would struggle to describe a typical entrepreneur. I think they're all very different people.
Well, that's good to hear. That's good to hear. Now, I think it's important for people to get some context as well, because I guess me quoting a statistic from 24, 25 years ago has no real relevance these days. Let's say, for example, 1,000 companies that actually get to a funding stage. How many of those would actually succeed past a year, past 2 years?
The rule of thumb is roughly around half. And it'll be somewhere around that number. Sometimes it's 40%, sometimes it's 60% of them will fail. Right. So roughly about half of them will actually survive. By survive, I mean not literally not be out of business. And there's a bit of a curve there, right? So out of that half that survive, kind of most of those will have an okay business, that makes money and it kind of works for the founders and everybody has a job and it's a successful business, but didn't achieve what they really wanted to achieve, or we hope they would achieve either. And of those,
Wow.
some fraction of those will achieve, and of those, some fraction of those will achieve, and it's a power law curve that ends up looking like.
Yeah.
Half of them will fail. Half of those again will be kind of okay businesses. Half of those will be great. Half of those will be even greater. One of those will be fantastic. And it's kind of like a typical curve you look like. It looks like in this
Mm.
space. So.
It's fascinating because when I was involved myself back in the late 1990s and early 2000s, the rate in America, I remember Silicon Valley. And again, I think it's important for people to understand it's not just Silicon Valley. America has, areas in New England, in Washington, D.C., in Plano, Texas, of all places. I remember Denver, Colorado was also a huge tech hub at the time. They are all avenues and hubs. But I think at the time when I was involved, it was something like 85 to 90% failed in the first year. And then in the second year, another 80 to 90% of whoever survived the first year failed by the end of the second year. It was huge. But the
Yeah.
tolerance for failure back then was pretty high because it only took one or two big bangers like a Cisco or an Nvidia, for example, that the VCs like Sequoia would be out there and they'd make their money. And you only need one Facebook in your life, and that's all good. So I guess from that perspective, Glenn, the kind of success rates you're quoting actually sound pretty good. Now, when you're talking about Fund WA, the next person or entity that's involved in this sphere. So we got the entrepreneur or the founder. So we then actually have the venture capitalist. So this is the person with money. How many of them are around, for example, today in Australia?
It's a good question. Actually, it'd be over 100 funds of various kinds.
Wow.
Australia's a
Okay.
lot, actually. Um, I lived in Sydney for 15 years, and there was actually another VC fund in our building. I didn't even realize. It's most of them are heavily concentrated in Sydney and Melbourne. That's
Mm.
where the center of gravity of financial services is in Australia, and that's where the VC funds are. So you walk around a couple of blocks around the Sydney CBD, and you'll basically capture probably most of them, actually, kind of in that kind of radius. It's very unevenly distributed across Australia in terms of where the VC funds are available and where the VC fund people are, actually.
Yeah, it's a fascinating thing. Again, I think geography has a lot to do with it. Networking and hubbing with people, I think, is really vitally important. And I know there were innovation hubs in places like Canberra, but again, Melbourne and Sydney is where the money is. And I think many people try and take the shortcut. When we talk about family offices, people may or may not know that term, but family offices are basically high net worth individuals that need to offload, ladies and gents, to somebody to run that on their behalf. But that's where VCs and startup founders will go, hopefully, and short circuit the process to maybe tap into some money as quickly as possible. So part of what we were talking about in the last show, you said one of the key factors that you look for is market timing. And so one of the things I wanted to talk to you in today's show was about the phases. In other words, not every company that comes and talks to you is at the same stage of development. Somebody might come to you with a total harebrained idea that's poorly formulated and it's just a bit of paper or it's just an idea. Others may come a lot further down the track. So let's talk a little bit about that. So when's a startup a startup? Do they actually have the mousetrap or the widget, or do they potentially come to you with just a good idea?
That's a great question, actually, and there's no real clear definition of it. Like the failure rates you talked about earlier, kind of 95%, probably that includes all of the companies all the way back to the very start. But I would describe the phases as starting with the ideation phase. Someone has an idea, right? Possibly they've worked on the idea for a bit. It's a paper exercise at that point, right? Or a
Sure.
head exercise. That's kind of where it is at the moment, right? And they've got to get out of the idea phase into something else, some other kind of venture. Possibly they need to create a company, to hold all this. Possibly they need to do things like that. So the next stage I describe after ideation would be F and F and F. For
Okay,
those that
I'm
don't
all
know, that's
ears.
family, friends, and fools. And in the last
Family, friend, and fools.
fools, yes.
Ah, I've not heard that one. That's excellent. I like that.
So the last episode last week, you talked about how the CEO's mother came in, right?
Yeah, that was my experience. Yeah.
That's a classic F and F and F, right? It's someone a family member who actually comes in and says, "I'm going to give you a small amount of money, generally, but a small amount of money is better than nothing, which is what you generally have, and to help you get the idea developed a bit further. So they might come in with $1,000, it might come in with $50,000. It's kind of in that kind of realm generally. And they basically say, I'm going to help that, push that bit further down the path. Basically trying to get them to a prototype or something that actually looks commercially viable. Like it looks like it's going to work. And what that looks like varies by sector. If you're talking like a B2C SaaS company, it's quite different than say, a medical device company. So they're a regulated space.
Sure, sure.
So whether, it's different, but the same concept of going through that kind of stage of like, I've got this cool idea. Oh, I've got an idea I think might work, and actually,
That's nice. So we like ideas that work.
exactly. Oh, does it work on this idea? It actually looks like it's got some legs, And I've gone and spoken to some people, and they like the idea too, type thing. And so, kind of moving on through that kind of pre-seed, seed stage, where you're going after a family office or an early stage VC, and then really kind of taking that idea to something that actually not just has legs, not just maybe getting some revenue, particularly if it's a B2C or B2B type product, but really starting to something that's going to start to get in the growth phase. They're like, it works. I can get customers, I've got sales, and I'm going to that Series A and then onwards from there, and, to see how far you can take it.
I think that's a really good question to ask then. It leads me into my next, I guess, quiz in that if we're talking about the three Fs, family fund, family, friends, and fools, if we put that to one side, if we think
Mhm.
about the 100 funds that you were talking about that are potentially in existence here in Australia today that are promoting themselves as saying, hey, pitch your idea to us. We'll seriously consider it if we think it's worthwhile. At what stage of, let's say it's a widget, it's a product, for example. At what stage do you think most of these funds are going to say, yes, I'll talk to you, or no, come back when you've got something a bit more?
Most of them will want to invest at Series A. Most funds are Series A. Series A is when you have significant revenues under your belt. You've got some traction. It's a matter of like, okay, this works. How big can I make it? Right? And
So
so,
yeah, that's fascinating because for me, there's no venture in that anymore. You see, this was where I've got to be honest. This was where I was looking at venture capitalists and going, well, you're not venturing anything. You want a certain dead certain already because if I've already got runs on the board, and I remember having this very conversation, I said, mate, I live in Sydney. I've got $1 million in equity in my house. I'll use that and get everything back rather than having to give up over half of my company to you. And so there was this real tension. Is that tension still there today,
oh,
Glenn?
absolutely, absolutely right. And it's a real tension there because the VC is trying to de-risk. They're trying to say, all right, I want to invest in a company that's going to work, and so I need to know that the risk has been removed as far as I can get. Right? And of course, the startup founder is trying to get the money in as early as possible because it's when they most need it, actually. There's this real tension happens there. And there are funds in Australia that do invest at seed stage or even pre-seed stage, actually. And my own FundWA, is a seed stage fund becoming quite early.
Mhm.
Most dollars in Australia go to kind of the later stage, and that's just a dynamic of the market as well. It's also a dynamic that we compared to other countries, we don't have much venture funding, so it's just a bit of a narrowing in the pipeline there at that kind of stage. So I
So,
think there's
so,
opportunity at that stage for VC though to
so
for
I
other.
guess in deference to say more prominent VC markets like the United States and Israel that we mentioned in the previous show, you'd say that Australia's VCs tend to look at companies that are a little bit more mature than, say, an American company might. Would that be a fair assessment?
I'd say it's probably that we have not enough VC overall, and therefore the pickings for VC firms, the number of VC firms that actually will invest in early stage, and
Uh,
so
uh,
there's
uh,
already not many in the first place.
yeah,
I
they're
guess
contextually smaller. Yeah, no,
it's
that's
even
fair enough.
smaller pool. It gets really hard to do
Yeah,
that. So,
yeah.
yeah.
Okay, well, look, we're just about at half time of our second show here on Venture Capital. I'm Ray Treverson, and you're here on Dollars and Making Sense, a weekly show about finance, money, and investing. I'm really pleased to have Glenn Butcher from Fund WA with me. We're going to go for a short break and be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson. At the microphone this week, we have Glenn Butcher from Fund WA. Now, Glenn, before we went to the break, we're talking about the different phases and stages of investment in a venture capital company. So we were talking about seed stage, and we've talked a little bit about startups and entrepreneurs. So you used the term Series A and Series B. So let's drill down a little bit into that. What does that actually mean?
There's a lot of norms around these stages, a lot of expectations. They're just labels, They're just
Hmm.
I call them marketing terms actually. Like freaking what a round is called is simply a marketing term, right? And
Okay.
so you align the term with where the company's at in its progression. And the norms drift. Actually, they're actually not fixed in time. They over time seed becomes a new Series A, or Series A becomes a new seed. Kind of it changes over time.
Right.
Um, but at the moment, Series A, or at least in my view, Series A is more that kind of pivotal point where the company's starting to take off. And starting to get that kind of traction. That's not true in the US, actually. The US is later stage than Australia. And so I've probably even described Series B or Series C as more like our Series A here, as
Right.
a of how things are different.
But I guess if you were talking to prospective new investors who were looking at FundWA or any other venture capital company, I guess the stages that you may focus on, and again, I'm making a supposition here, is that various VC companies will have sweet spots. They'll be good at seed capitals, others will be better at later stage. So their real forte is actually investing in companies that are further down that track, but they've got the ability to really propel them and accelerate them. That's a very different beast, for example, compared to somebody that identifies that rough diamond and goes, I'll invest in that piece of carbon because I know with a bit of pressure, we're going to turn that into a gem. Is that a fair assessment?
100%. Different people, as well as different funds, are good at different stages. That some of them are better at seeing the diamond in the rough, kind of seeing around the corner and seeing what this thing could turn into.
Mm-hmm.
Others are better at a different stage, right? And so there's a bit of a match there for the company to the fund in terms of the stage that the company's at too, to match with the stage that the fund does, in terms of what their particular sweet spots are. And so um, it's like I was thinking it was like children. Children grow up, they go through stages. You got to match things, for the age that they're at and the stage of development they're at. And if the age of development and the stage of development are out of whack, then it starts becoming a problem as well, right?
Absolutely.
The child's too old for where they're at. They've got some kind of some kind of developmental disorder. They happen to companies too, as well as people. And so that's something
I,
we look
I
for.
could venture that for Elon Musk and Zuckerberg and a few others, no doubt. But
Yeah.
it's for another time. We could joke about that for sure. So I guess when investors are looking at a venture capital company, I guess part of their due diligence they really need to start thinking about and looking at critically what phases in the investment cycle they're good at, because I guess it goes without saying, but let's say it, if you've got somebody that's good at seed capital, but then they start delving in a later stage company, they could potentially fall foul of lack of experience, I guess. It's a fair comment.
That's absolutely a fair comment, and I would definitely hold with that. I look at in venture capital, I look at it frequently as a game of passing coming on to the right pair of hands. And your early stage investors, are really crucial there at that kind of early stage, into a company. But as the company grows up, they might need different people as well. And so the early stage investors become less important to the company. I talk to
Yeah.
my startup CEOs, most of them I talk to most days of the week, actually. We have phone calls regularly. They call me up for advice about something or other. Um, and I'm like their mother. There'll be a point where they no longer call me.
Well, I guess it's one of those fascinating things. Because of my own experience in this ecosystem, I find it amazing and also a real testament to the prowess of both the Atlassian guys to have been there from day dot, and the investment community to have had faith that they are still. I mean, one of them's now moved on, I think, more for personal reasons, but the management and running of Atlassian has, I guess, for all intents and purposes, remained constant through its evolution and its incredible success, which, you've got to take your hats off to them and say, you know what, you guys really deserve your success. It's a hell of a thing they've done. And so I guess, do you see that a lot, or do you see, for example, there's again, I'm just referring to popular culture, but there was a Netflix movie Intern where they had Anne Hathaway started up an online thing, and the VCs came in and said, we think we need a different CEO. And so you're dealing then with personalities. We were talking before about the team. I mean, that's got to be hard because it's like a baby, isn't it? You're trying to say to a founder, I'm taking your baby away from you. You must have had plenty of those conversations in your time.
It is a very awkward conversation to have.
Oh,
Look, it's
oh,
preferable
I
to have the
bet.
same person all the way through, and preferable to find that person right at the start, actually, who's capable of growing. Most of them don't have it in them to run a big company. and you don't know, and they don't know whether they're capable of doing it because they haven't done it before. Atlassian was Mike and Scott's biggest company they ever ran. And they were learning as they went. I know I was there, and I saw them visibly learning as they were going along. Now they're amazing guys, and so they learned fast. But it was a learning exercise for them as well. They weren't born not knowing that. And they were capable of seeing all the way through. Not everyone is, and sometimes, things happen as well. And sometimes it becomes no longer the right person. But that's not a preferable conversation to have. It's much
No.
preferable to have the same person leading the helm the whole way through if you can.
That's got to be tough, and I guess it would spook investors too. So let's talk a little bit about the investment community, because this show's about money, finance, and investing. And I guess what I'm trying to do with your help is to educate the investment community a little bit, to not look in this space as being so risky that it's money that only you can afford to lose, that you would ever potentially put into, say, something like FundWA or similar companies. Would that be a reasonable assessment? I mean, just because you invest in VC doesn't mean you're automatically going to lose your money 99 times out of 100. Is that is
No,
that
actually, no. I mean, that's the whole point of having a VC fund in between you and the companies. Um, if you're an angel investor, so an individual investor coming into a company, you neither, or you don't have the time to really do the right work on that company. Rarely do you have the time to do that.
Mm,
You might have the skills. Frequently, you made money, and that's why you have money to invest as an angel. But you don't have the time to actually do proper due diligence, to work with the company to be successful. You kind of don't have that kind of capability of really working with that. So having that entity in the middle is actually having that entity of the people in that team that actually go and do all that work on your behalf. So from an investor point of view, it is a passive investment. You don't have to actually do all that work. You give that money to the managers and they go and do all that work for you. And they will then diversify across a bunch of different kind of investments on your behalf as well. So that, while of course, the fund will lose money on, many of the investments, others it won't. And so
okay.
that's getting that diversification through that as well.
You used a term that we haven't sort of explained just before. So you used the term angel investor. Can you explain to the listeners what that actually means?
Hmm. So an angel investor is an individual investor. It's frequently a bit of a stage that they come in. So it's a bit later than F and F and F, but it's kind of around that
But
stage.
they could be one and the same, couldn't they?
They could
The
also be
FF
one
and
of the
F.
same, yes.
Yeah.
If it makes money, they're not a fool. If it lost money, then they were. Like, but
when
frequently an
when you're
angel is
looking
someone who's
when you're looking backwards, you're going, that was a fool, that was an angel, right?
that's right, yeah. No, so an angel is someone who comes in and says, "I've got some cash. I'm going to give you some cash." The difference I would say between F and F and F and Angel is that an F and F and F is someone who says, "You're my cousin, you're my son, you're someone I know. I'm going to give you money, but I don't actually know anything other than that." An Angel is someone who has some relevant experience, some business experience. They've made money in some other way. They bring something to the table. It is not entirely dumb money. There's some smarts to it as well.
Yeah,
Um, but they're coming in still at the very, very early stage as an individual just deploying their own capital.
I've got to say, I get the feeling that angels are probably a little bit more successful, because when you use the term FF and F in the previous show, I'd not heard that before, mind you. Yet I have to tell you, privately or very openly and publicly on the show, but pretty well most people that I know that have invested as an FF and F have failed. They've lost their money.
Mm.
Thankfully, when I was at Carbon 12, George's mum, did save her money and actually made, some from it. And I was always very pleased for her. But man, so many horror stories there. I know people happily have done this for family or for friends on the guys that they didn't know what they were really investing in. But for mine, they've been led down a garden path. So, and a money and their fool are soon parted, I think is the term. So I think it's one of those things. It's just like, wow.
Well, I think I
It's
think I think
fascinating.
calling someone a fool is probably a bit too much. I mean,
Yeah, it is tough. It's
I
tough.
probably will say it as, and I've been in that position myself, and I've done this myself, where I said, you know what, I'm going to back this person, but I don't think I'm going to make any money at this,
So
and
you're happy to write it off if it doesn't happen.
that's right, because basically, fundamentally, I'm like, I'm going to back this person. They're giving me a red hot go, and I'm going to give them some money, for the sake of the personal relationship I've got with this person, because I want to back them and give them a good shot at getting this done. So.
And I think in the mode of paying it forward, when you do that for an entrepreneur or somebody that's out there willing to give it a go, and I've seen this, and I've seen investments as little as $5,000 or $10,000. I consider that to be chump change, but for somebody that's young and doesn't have a lot of money, that could mean the difference between life and death. Not literally, but you know what I mean in that regard. And
Yeah.
it gives them permission to fail. And we were talking about this in the previous show. I think we can also build the credentials of potential founders really well by giving them permission with fool's money. And I'm going to use that in virtual inverted commas. We're actually giving them permission to fail and have a go at something that might be so damn harebrained. Yeah, it might fail, but hey, if it took
But it might
off,
not.
yeah,
Yeah.
it might
Right.
not. But
Right.
I think one of the things that I really want to see, and I'm hoping as I grow older that I have the opportunity to invest in that manner and show faith in young kids that are out there and they come along and pitch an idea and they go, it's a bit harebrained, but you know, if you've got 5K that, as we've said, you're happy to lose, that 5K could be more than enough. And I mean, and again, help me out here. 5K 25, 30 years ago sounds like a lot of money back then, but you can do so much more with it now with the internet and AI and a whole bunch of other stuff. I mean, you can do an awful lot of work with 5K, don't you think?
Well, I think if you're just starting out with your idea, you might have nothing. You might have no savings, nothing that you can personally put into it, or you've deployed all your savings into it. And 5K might be enough to get a contractor for a period of time to achieve some bit of work you can't do
Yeah.
yourself.
Proof of concept.
Do a proof of concept. Like there's a lot of stuff you can potentially do with that. It's not going to cause you to quit your day job and do that necessarily, but it will allow you to get further than you otherwise would have. So I don't undervalue the value that an early stage investor brings, to the table with
Oh,
that little bit
no,
of
nor
money,
do I. I think
and
it
the
could
faith
really
they bring there
boost
as
them.
well.
Yeah, faith.
And
Absolutely.
faith. Yeah,
Absolutely.
and I think that's probably worth at least as much as the money. Like having someone back you and say, you know what, I believe in you. I think you can do this. Give it a go.
Okay, believe it or not, we're just about out of time now. Maybe not to this particular session, but maybe another one, Glenn. I still want to talk to you about terminology in the ecosystem and term sheets and pitching events and exit strategies. Ladies and gents, I love this stuff, and so does Glenn. You know, look, it's been a real pleasure having you on the show. Glenn Butcher from WA Fund WA, not WA Fund WA. We're actually going to talk a little bit about your organization next time around as well. Glenn, thanks so kindly for being on the show.
Thanks for having me.